Hello and welcome. You're watching Business Today Television. This is Market Today. I'm Sakshi Batra and with me is Shail Bhatnagar. Well, yesterday we did see the Nifty fall for the third day in a row, and that was during its weekly options expiry on Thursday. It's now declined in 4 out of the last 5 trading sessions as well. Yesterday, barring the IT, every other sectoral index did end in the red. And these 3 days of losses on the Nifty have ensured that the Nifty is now down 0.9% for the week. Even though it's not an alarming number, but the index is also now down for the third straight week in a row. If we continue to fall today, it will confirm this third week of loss as well. But, of course, the run-up in the IT sector also yesterday will now be tested because 2 of the key numbers will get a reaction today on Infosys and on Wipro. And there are several other news points that we will be tracking for you as will be impacting the market sentiments and key sectors and stocks as well. Good morning to all our viewers and good morning, Shail.
Good morning, Sakshi. And would you also mention the net FII sale number for yesterday, and then I'll...
Okay, so I guess we have lost Shail's voice. We'll try to fix that up. But in the meanwhile, I will be just highlighting for all our viewers. Remember that overseas investors have remained net sellers of the Indian equities for 14 straight trading sessions as well. FPIs have offloaded stocks worth about 7,421 odd crore rupees just as of yesterday. Remember, before yesterday, it was a tapering down number from the FIIs, but that has suddenly shot up in yesterday's trading session to 74.21 crore rupees as a sell-off. Even though domestic institutional investors did buy 49.79 odd crore rupees, but it was far lower than the sell-off as well. In fact, in all of October, nearly 85,000 crore rupees, worth of stocks have been sold by the foreign institutional investors as well. And this seems to be the peak since COVID-19 period as well. Shail, so that's as far as the FII number is concerned.
Okay. 7,421 crores worth of net sales, and the most critical thought process behind this, ladies and gentlemen, is for the 13th session in a row. We are on October 18th. So far in the month, there have been 13 sessions, and in each session, there have been net sales by FIIs. That number is now a total of 84,000 crore rupees. Yes, DIIs have come in with money, but the net sales on FII numbers have been very well targeted. That has hit Nifty in particular. And today, the fears that this was a dead cat bounce, something that I have mentioned repeatedly on a regular basis, that there is this very heavy possibility that the rally from 24,694 to 25,200 is a dead cat bounce. Those fears will come true today. The cues that are coming in from Nifty point to a 100-point downtick. So with that, the low of 7th October will be taken out, and possibly you just might see the Nifty heading towards the 100-day moving average. Now, what all has triggered this? I think yesterday's fall of 221 points on the Nifty was the most critical direction which the sensible investors have given us, and it started with 3 major companies announcing negative set of either numbers or guidance. Bajaj Auto, in fact, it trashed the entire two-wheeler market by giving cues into very, very tepid sale numbers, rising raw material costs, and a muted future to look forward to. Then came the numbers from top FMCG giant Nestle, where the margin and the profit number weren't up to expectations, and the final straw was Havells. Havells' margin slipped substantially, pointing out to problems ahead. All 3 stocks lost substantial ground. With that, the Nifty fell dramatically, and now you have numbers coming in from Infosys and Wipro. Infosys numbers are muted. They have improved the guidance to the extent of 3.75% to 4.5% for the quarters ahead as far as sales is concerned. The earlier one was 3 to 4%. Quarterly sales have risen about 3.2% quarter on quarter to 40,986 crores, and of course profit after tax is up 2.1% quarter on quarter at 516 crores. So while the numbers are okay, but Infosys is already at a record high. These numbers will not change the trend either for Infosys. In fact, I believe you'll see profit booking on it today, and of course Wipro. The numbers on Wipro are also good, but the problem is that they have reduced the sales guidance. In fact, they've given a negative sales guidance for the third quarter, -2% to 0%. So that's the pain point in Wipro. Of course, they've given a 1:1 bonus, but my understanding is that both these stocks will go down. Numbers from Axis are good. Sakshi will give you those details. But overall, ladies and gentlemen, my understanding is that probably we need to tighten our seat belts further. This is one of those corrections where the shallowness part of it is over, which essentially means earlier the markets were correcting 3-4% to 50 DMA to 20 EMA, but all those lofty thoughts are now over. Please get ready for a deeper dip. Of course, the broader sentiment remains well, but this could be the removal of froth that is coming in. Hyundai's IPO probably is the trigger for the market to take a deeper correction. Remember, the IPO was subscribed, but it was the QIP portion that brought it to the final race. Let us see how it gets listed. Apart from that, these 3 or 4 counters, I am also looking at Zomato. They've done an act of strategic brilliance. They will be raising a QIP even though they have enough money on their balance sheet, and this is ahead of their rivals Swiggy's IPO around Diwali. So brilliant tactical move by Zomato. They are raising funds before the rival gets listed and probably sucking away crucial money that could have gone into Zomato, but that could have gone into Swiggy, but will now come to Zomato. So these 4 or 5 stocks that I have in mind. And as far as the Nifty is concerned, there is heavy call writing now happening at 24,900, 24,800, which is adding to the selling pressure on the index, and support levels are now only at about 24,600, 24,500. Let us see how the market negotiates this gap down. Will this dead cat bounce reverse? Only time will tell, but I think we are getting ready for a bigger correction, mainly because second quarter earnings haven't been up to the mark across the sectors, whether it is IT, whether it is autos, whether it is FMCG, or whether it is companies like Havells, which are in brown goods and they manufacture the back end of the entire capital goods space. So that is what is how Indian markets are structured. Let's get to Sakshi and understand the green tick on Dow, which also ended at a record high. Sakshi.
Absolutely. So in the US, the Dow Jones rose by 0.4% to close at 43,239. Remember, this is the 4th record close in a row that Dow has posted. The S&P 500, however, ended just flat with a negative bias. This is after, in an intraday session, it had definitely recorded its own record high as well. The rally overnight was led by the chip-making stocks or the semiconductor-led stocks. Nvidia ended the day up by about 0.9% after earlier notching a new all-time high. The shares of TSMC also closed up 9.8%. That led the overall move in the semiconductor stocks as well, and that's pulled up the overall markets as well. Nasdaq almost ended by 0.03% higher in trade, but it was the Dow Jones that actually took the cake yesterday. When we look at the Brent crude levels, they were trading higher by 0.3% at $74.68 a barrel. We'll keep an eye out on that too. Following the overnight session on the US markets, most markets in the Asia Pacific region also rose in the earlier trading session. When we look at the Nikkei, That's trading up by about 0.3% in trade. However, the Kospi has lost a bit of ground, 0.3% down. Hang Seng and China indices are both up and about in trade, whereas the Gift Nifty trends are actually indicating a flattish to a negative start in the Indian markets. 24,729 as of now is what we are actually looking at for the beginning of the domestic indices back home. Now, of course, we have already highlighted for you how the FPIs have been big sellers for trade yesterday, 7421 odd crore rupees, while the domestic institutional investors, they bought 4979 odd crore rupees worth of stocks yesterday. Let's look at the key numbers then. Infosys, India's second largest IT services exporter, it reported a 5% rise in its second quarterly net profit. It raised the revenue guidance for the year on a broad-based recovery in demand, particularly from its key financial industry clients. The consolidated net profit of 6,500 odd crore rupees in July to September, the second quarter of this fiscal, was 4.7% higher than the year ago earnings and 2.2% higher in the net profit in the previous quarter as well. Wipro again has reported a 21.2% increase in its consolidated net profit to 3,208 crore rupees for Q2. It had reported a profit of 2646 odd crore rupees in the year ago period. Revenue from operations have been reported at 22,300 crores. That's almost a percent decline from 22,515 crores in Q2 of FY24. The company's board, however, has approved a 1:1 bonus share now. LTI Mindtree, the company reported a consolidated net profit of 1251 crores, reflecting on a year-on-year increase of 7.7%. And sequentially, the profit grew by 10.3%. This Mumbai-based IT services provider has posted a consolidated revenue of 9,432 odd crore rupees as well. Axis Bank, here the standalone YOY numbers show that the NII was up 9% at 13,483 odd crore rupees. The net profit was up 18%. At 6918 odd crore rupees versus 5864 crores. The net NPA was flat at 0.34% sequentially. The gross NPA slightly lower than last quarter at 1.44%. CIAT also came out with the numbers. Here the revenue improved by 8.2% in this quarter. EBITDA, however, declined by almost 21%. And the margins also came in sharply lower at 11% versus 14.9%. The net profit was sharply lower by 42% as well. We'll also keep an eye out on Reliance Industries. The brands in the retail space have entered into an agreement with Mothercare to form a JV of 51-49 ownership structure in South Asia. And this joint venture will own a Mothercare brand and its intellectual property rights across India, Nepal, Sri Lanka, Bhutan and Bangladesh as well, and Reliance Brands will be owning a 51% stake in the JV for £16 million. We will also look at real estate major Prestige Estates. The company has in its second quarter business update recorded another 43% surge in sales, reaching 4,023 crores on a year-on-year basis. Realization has improved by 1.5% and collections have also grown by 4% as well. So these are some of the stocks that I'm keeping an eye out on, Shail.
Ladies and gentlemen, please also bear in mind that stocks such as Reliance Industries and L&T will be used by very sophisticated traders and large institutions to buttress and cushion this fall on the Nifty, as also private sector banks, at least some of them. Remember, the fall on the bank Nifty is not as much as it is on the Nifty. The bank Nifty, if you see the long-term chart, is yet to test its low of 7th October, which was somewhere like 50,190. We are still at 51,288. So there is at least 800-900 points for that to happen. Will it happen? Only time will tell. But the point is that some of the stocks might buck the trend, and among them the possibility that L&T and Reliance play anchor's role is very much there. This is not to say that they don't have problems, but those problems have already been sorted out in the market. Both of them are below 200 DMA. So this balance of the market being sort of not killed altogether will always happen. In terms of weekly losses on the Nifty, remember today is Friday, the bright spots are, hold your breath, HDFC Bank 1.3% higher. Remember, this is the highest weighted stock both on the Nifty and the Bank Nifty. It hasn't done anything at all as far as markets are concerned for the long term, and this could be used as an opportunity by traders to cushion the fall on the Nifty. Apart from that, the top loser is Bajaj Auto after yesterday's stunning reversal of fortunes. Axis Bank is the top loser in the banking space, down 3.4%. Bajaj Finance down 5.5%. ONGC down 3.7%, and Tata Steel down 5.2%. So this is how the structure is of the market and the Nifty, and this is just the right time to welcome our very dear friend Mr. Mayuresh Joshi, Director for Equity Research at William O'Neill India. Namaste Mayuresh ji. Quite a volatile and turbulent time on the markets. Yesterday was not something that a research head would look forward to. The top ranking performer in the two-wheeler space, Bajaj Auto, comes out with a stunner. Havells disappoints, and Nestle says that the chocolate is a little bitter. How do you see sentiment on the Lal Street now, and what are you advising your top clients?
Morning, Shail sir. Morning, Sakshi. I think down but not out. India might have got around for 46, but we've seen what happened in Australia, right, a few years back. So we bounce back in the next two tests. I think Indian market's on a similar footing. I think there are knee-jerk reactions happening. There is some element of corporate booking, stroke, FIS selling that is happening into the market. But the core fundamentals still remain very, very strong and robust. Obviously, a few leading indicators, including how GDP growth is expected to play out, government capex probably slowing down a tad bit. But it is obvious, Shail sir, because I think there are a lot of state elections happening. And because of that, you are expected to see some element of slowdown. Obviously, the first quarter had the general elections, monsoon, and therefore I think there should be a pickup that happens in government capex. One interesting data point that I was going through, private capex has actually started going up. So it's at 5.61 lakh crores compared to 3.53 a year back. So I think that is a huge, huge positive element that will happen for the markets. GST collections are robust. And therefore, I think corporate earnings is something that the market is now looking forward for. And we've always believed that this quarter is going to be soft. Largely, this year might be a little bit soft. Even in the US context, the numbers in terms of Q3, Q4, which is the current quarter and the next quarter, might be a tad bit soft. But we'll have to adjust to corporate earnings on an annualized basis. With good monsoons, the expectations of rural recovery genuinely happening in the second half seems to be on the card. The cabinet has approved MSP rises for 6 cash crops, which should also augur well in terms of rural discretionary spending. And therefore, my take is that third quarter onward, you should see some stability in earnings coming back. And next year, a 12 to 14% earnings growth is something that the markets can look forward to. So I think it's an adjustment factor that is probably happening for the markets. Nothing really to worry about a structural downside for the markets. I think if the fall comes, if there are good stocks that make bases at lower levels, I think there are good times to buy.
Okay, very good morning to you, Mayuresh. Good to see that bright prospect in a weaker sentiment that we have been seeing thus far. We're just about 10 days away from the peak festive season, yet the festive cheer is completely missing from the D Street. I wanted to ask you, what are you keeping doing, or what's your strategy to keep yourself motivated in this dull market? And are you just absolutely not looking at the market right now, or are you bottom fishing at this point in time? What is it that you're really doing?
So Sakshi, morning to you. I think I hope you had a very good vacation. In two parts that our founder has probably put forth, William O'Neill. So one of his quotes is, "Bear markets or corrections are necessary because it paves way for identifying good stocks for the next rally or bull market that is to come." And the second quote that he has probably put forth, which I agree completely, is that I've never seen a successful pessimist. So to that extent, I think in volatile times like these, in times where markets become a little bit choppy, I think our research becomes even more active. We try to look out for sectors where earnings might probably hold out. We try to look out for stocks where if any probable corrections do come through, and where there is element of quality of earnings remaining very, very stable as we see through our EPS and RS ratings, and where there is some element of sectoral churn looking at global and local events as well. I think that can play out meaningfully in terms of the correction. So yeah, I think these are actually good times for keeping your ears to the ground and trying to scan good ideas if there is further correction of the markets.
Okay. Mayuresh, let's look at how Bajaj Auto has practically set the trend for the entire sector. So TVS was down 5% yesterday, selling pressure on Hero Motors as also Eicher. Where do you see Bajaj Auto settling? We've seen 12,000, 12,100 on Bajaj Auto, and now somewhere like 10,100. Do you think the froth is over, or is the investment thesis on Bajaj now diluted completely?
No, so two parts to your question, Chelsea. One, I think the numbers were not that bad, but I think it was the commentary which probably did what it did to the Bajaj Auto stock.
Yes.
Obviously, I think one must understand, I've always been repeating this time and again, I think the last 2 years have been absolutely stunning for the auto industry, both in terms of volume growth, both in terms of new launches. And therefore, I think a lot of auto OEMs have done exceptionally well over the past 2 years. Bajaj, Hero, look at TVS. Hero has got a late recovery. It had underperformed for the better part of the first quarters of the last 2 years. And even the PV and CV players. So to that extent, with the high base that these stocks have created, it's not possible for the market to keep on growing at this pace quarter after quarter. And there will be some element of slowdown that will happen in terms of both sales as well as expectations on how new launches will take place. But two things happening. One, I think new launches have happened. Bajaj has introduced the hybrid. There are a few more launches that are expected by competitors as well, both in the ICE space as well as the electrical mobility space as well. And therefore, I think this space will see a lot of traction as we head into the second half and the next financial year. So again, as was mentioned, for corporate earnings, second half, there should be some signs of stability that should come back for the sector as a whole. And next year, I think there should be some element of gradual recovery, which will mean that numbers should remain steady in a steady state in the second, from the first half of the next financial year. Obviously, I think how input costs play is going to be a very, very integral part. But with interest rates expected to be cut, with expectations of rural recovery expected to come back strongly, I think a lot of these two-wheeler stocks should come back in focus as we head into the next quarter. So to answer your question from a price action perspective, yes, we've always maintained that with the price rise that the stock had seen, the higher base that it created, as we saw in markets and the valuations as well, it was a little bit untenable. I think the market saw it as an excuse yesterday. If it corrects further, I think it should settle down around that 9,500, 9,800 mark kind of a range. It might consolidate. But as numbers start coming through, which might be a tad bit better, I think it might be a good opportunity for selectively choosing these 2 and 4 bases.
Mayuresh, we will also talk about the IT space. At least the big 4-5 companies have come out with the numbers now. What are the early indications looking to you? Is it more towards downgrades than upgrades as of now? Is there a general miss on the margins and as well as the outlook, or do you think this is the right time to start looking at the IT space?
No, so Sakshi, I think the space has moved up significantly. So there is no two ways about it, right? So large cap, mid cap, valuations higher side in terms of your standard 5-year standard deviations. And the markets are penciling to a large extent all the positives that will come through. The Fed rate cut, expectations of BFSI recovering, retail manufacturing showing stability and showing signs of recovery. Q1 of the next financial year for US companies where discretionary spending budgets are determined and decided, there will be an uptick on that front as well. So Infosys in line with estimates, TCS a little bit disappointing, Emphasis has outperformed, LTI might be in line again with estimates. But I think there was a very interesting slide from Emphasis presentation, if you've seen that. And what the management has mentioned is tech is disrupting tech. So if you probably look at the signs going forward and the kind of traction that IT outsourcing companies, which are predominantly what Indian IT companies do. In terms of tech, disrupting tech, in terms of automation, in terms of AI, in terms of generative AI, in terms of cloud computing. I think all those aspects and the strong moats that IT companies have, there is going to be an expected accelerated spending that might come through the next 4 to 5 years, specifically across geographies and across segments as well. So I think well placed. Obviously, I think mid-cap, as I've always kept on maintaining, might outperform large caps. But as spending budgets evolve in the first quarter of the next calendar year, my own sense is that there will be huge multi-billion-dollar deals that will start flowing through in the next financial year.
Okay, ladies and gentlemen, 8:58. We still have a minute to go, Mayuresh. A quick one. Where do you expect Hyundai to get listed? Below its offer price? And any hopes that you have on Vari Energy?
So not really sure of Vari, but yeah, I think Hyundai might open up above its offer price. Very difficult to take a call, but yeah.
Okay, Sakshi, remind me today, I'll talk about gold. It's up 3.8% in the last 5 sessions, $2,700 an ounce. And for all the effort, ladies and gentlemen, that we make for picking stocks, trading, putting in algo, let me just tell you, the Indian housewife has beaten you handsomely. 1 year return on gold is 43%. From the start of the Israel-Gaza war in October 2023 to October 2024, from $1,881 an ounce, we are at $2,700 an ounce. So please, when your better half or when your friend who's a girl asks to buy gold, please give her more respect than you give to the top fund manager in India. Nothing that they have done in terms of just buying and holding, they have made more money than all equity strategists put together. With that, let us begin the market. 200 points lower on the Nifty, ladies and gentlemen. 24,572 is upon us. Good, bad or ugly? Let's start with Infosys. In the green, 1% higher, 19 rupees 90. What is pulling the index lower? HDFC Bank, 56 rupees lower. TCS, 55 rupees lower. Axis Bank, 31 rupees lower. How about Reliance? 7.5 rupees lower. And how about Infosys? Now just 1.8 lower. This is probably going to improve for the better. Bajaj Finance, 40 rupees lower, 68.59. Kotak, providing support, 20 rupees higher, 18.84. This is how the top 10 super index heavyweights are performing. I also want to see what is Wipro doing at this point of time. Remember, a 1:1 bonus has been given, 2 percentage points higher, 538. But it has come out with a negative guidance on the third quarter. In fact, it says that sales might dip between -2% to 0%. Okay, let's get back to NSE 500. Okay, Tata Chemicals 3.3% higher, 1110. Oberoi Realty 2.5% higher, 1950. PVR Inox 2.5% higher, 1650. So it's pharma all the way. Suven, Zydus, Lupin, all of them are in the green. So that's the defensive part of the market. Thankfully, the index is now down just 64 points, 24,686. Coming back to Mayuresh. Mayuresh, your top pick for jewelry stocks. Where do you think is quality? Where do you think sensible people have taken positions? And where do you think your quality stock in the jewelry space is headed?
So as you pointed out, I think the entire play shelter between organized and unorganized is moving for jewelry as well. And the expectations is that the organized market share should be around 55-60% over the next 3 years. Having said that, I think with gold prices the way they are and expectations of wedding sales expected to pick up in the second half, most stocks have done well. So Kalyan, PC, Senco have done exceptionally well. Kalyan's commentary has been exceptionally good, Shail sir. So I think anybody holding Kalyan should hold on.
Yes.
But from a risk reward perspective, I think Titan has largely done nothing. And the expectation is with more the portfolio probably getting tweaked towards wedding jewelry, which is probably lacking. The expectations in terms of studded share actually improving. And the expectations in terms of their other business segments, including watches and the eyewear precision engineering segment, also expect to show stability. I think this is one stock where I think the risk reward probably favors gold jewelry stocks at the current jobs.
Okay, Mayuresh, we are again seeing about 125 points dip in the pre-open. We've slipped below now 24,700 that most of our technical analysts were seeing as a crucial support level as well. There could be some more downside probably looking at the current trend. October bears have continued to rule. Where could be the bottom in place? Is it very difficult to assess at this point in time? Or by when will you start looking at incrementally pouring in fresh funds?
Difficult to call the bottom, but again, as we look at it at Markets with India, right, the distribution day count has increased. You've seen a lot of stalling, so there might be a knee-jerk reaction into the market. But if the market does correct a little bit more, as I've always maintained, I do not see a structural downside for the Indian markets. Domestic mutual funds, AIFs, PMS have decent amount of cash reserves. So at some point of time, they will start coming in. The reallocation that is probably happening as a base case thesis towards China, I think China is still showing no signs of recovery as far as data points are concerned. And from a recovery perspective, as far as the real estate is concerned, and in fact, even the commodity market, it's still some time away. So my own sense is that I do not foresee a significant structural downside for the market. If the market does correct, as I said, some pockets in the market where we are studying and we're looking at very, very intently, they do come down and stocks come down. I think they might become a good entry point as the market probably starts showing initial signs of bottoming out.
So which is the first sector that you believe will be the one where investors will put in fresh money once the recovery after the bottom really starts?
So I think some part of domestic cyclical, Sakshi, I think that is where I think the focus will be, because as I mentioned, government capex, private capex coming back will mean that a few of these domestic cyclical stocks, selective infra names, selective cap goods names, you've got select cement names as well, which might start getting looked at. I know everybody is ignoring consumer discretionary at this juncture, but again, I think our base case scenario is that as incomes start coming back, specifically on the rural side, urban has largely held up. As inflation starts coming under control or remains stable, specifically on the core part, you will see certain pockets of consumer discretionary will do well as well. And I believe the ancillary stocks, as an example, real estate ancillaries, select auto ancillaries, might actually also incrementally see earnings remaining stable and improving in the coming few months.
906, the prices are sort of settling down. Axis Bank, thankfully, is back up in the green, 2.4% higher. Sakshi, I have this feeling that you just might see PSUs being used, particularly defense counters, to offset the decline in the broader market that we have. Remember, while we are bracing for further pain, the cause of the crisis, which is the Middle East fiasco between Iran and Iraq, Iran and Israel, seems to be, sort of maybe at least moving towards a settlement with a major Hamas figure being taken out yesterday. So it's not all that bad. Let us see how things work. But Mazgaon Dock 1.5% higher, 4305. You have a strong move coming into counters such as Paras Defense 1056, BEML is doing well, and of course in the PSU basket, PNB back into action. Remember, they just did a QIP at 105 rupees, so they have a war chest to lend, and the stock has also corrected substantially. Let's go to Mayuresh and find out the best stock that he thinks in the corrective rally that has happened on the PSU banking space. Mayuresh, we will request you not to name SBI, and we will ask you the top research bet on the PSU side as far as banking is concerned.
So Bank of Maharashtra, well, sir, I think numbers have been decent. The expectation is that the entire deposit saga that is plaguing the entire industry, I think, because of the legacy accounts that they probably hold, they've got a steady flow of deposits that keep on maturing and getting renewed. And therefore, I think with asset quality pressures remaining stable, expectations of decent capital adequacy, strong provisioning that has happened on the balance sheet, all write-backs that probably happen on their or in their current financial year will probably come back to their bottom line. And therefore, I think mid-cap PSU banks in a sweet spot. Bank of Maharashtra remains one of our picks. Clear disclaimer, I don't own the stock, but it remains as part of our global portfolio stocks.
Yes. Okay. And look at the 12 rupee correction that Bank of Maharashtra has had over the last 5-7 months. These, ladies and gentlemen, are the opportunities to buy. Remember, at 65, 67, the entire world, all momentum traders, every single algorithm that runs on cash stocks will give you a buy call. But nobody will give you a buy call when the counter is corrected 25%, when actually you should start buying quality. And nevertheless, if you can be fearless when you buy fear, you've mastered the art of markets, and that is what we try to do at our place in business today, to tell you about quality stocks which are trading much below their fundamental value and much below their all-time highs, to buy into them, wait for 1 or 2, 3, 4, 5, 7, 10 months, and to reap a much better return on the market than a 16-17% CGR that most market people feel very happy about. We'll also show you the chart of Bikaji Foods. This is a running commentary between Sakshi, Mayuresh and me. Mayuresh, they just bought hazelnut factory in Jaipur. I know that you've sort of taken off the the buy recommendation on Bikaji, but how do you see it now? It's getting into the QSR space.
No, very interesting. And in fact, Shelter, if you look at Gopal Snacks, just its competitor, right, the commentary thereof as well. So they are actually getting off those 5 rupee packs. So they are introducing higher packs. So that's point one. Gopal Snacks commentary is suggesting that their margins might actually expand from 11.5% to 14.5%, and the revenue growth in higher double digits. So I think if you're probably looking at how the space is evolving, the expectations of organized players, as I've always maintained, gaining market share over unorganized players, getting into those rural areas with different SKUs. And therefore, I think as the distribution spread increases, as their omnipresence spread increases as well, both through e-commerce in terms of retail reach, direct reach, my sense is that there is a huge scope of growth that will come through for the space as a whole. Obviously, valuations is something that you need to keep in mind and pencil in how much growth is probably getting factored in at the price at this juncture. But very, very interesting space, Shelter, as I've always.
Okay. Well, Shail, you were pointing out at gold and silver. Turns out they've heard you. Record high levels now on the MCX for gold, 77,500 cross per 10 grams on gold for the first time. We are also seeing silver inching higher by 900 rupees per kilogram at 92,650. This is as we inch closer to Dhanteras, Diwali and the entire wedding festivities as well. For those who actually bought it at the right time, they must be laughing their way to the bank. But for others, this is going to be a very expensive festive season and wedding season in case you still haven't bought all your gold and silver. There you have it. You have all-time high levels right there. Shail.
Sakshi, I went to a pre-IPO jeweler meet in Ahmedabad. This gentleman designs, is responsible. 40% of this company's turnover comes from Titan alone. They make jewelry sets for Titan. and the kind of trends that this gentleman shared with me were phenomenal. There are many NRI families who are now getting their wedding jewelry designed on Instagram and getting that thing executed in India. And there is in less than 2 or 3 years, you will see men gold jewelry chains being set up. These are trends that I often get right, and 4 or 5 of them in the past 30 years have worked out well. But get ready for men jewelry, branded gold jewelry chain, and men are not going to buy 25 grams, my apologies, a small tola. They will buy chunky jewelry, and I am the biggest buyer here, and this trend is started.
I wish we had the picture right there from your
5
Facebook
years
to
from
pull up
now,
and show it to all our viewers right there, Shail. We do have that photograph. Yes, Mayuresh.
I would love to see
Mayuresh wants to say something. So, I have that avatar, but I make it a point not to get clicked. I don't want to get kidnapped.
I can just give you a sense, even if we can't show you a photograph, Mayuresh, that Shail is giving a tough competition to Bappi Lahiri's collection. Now you can well imagine what he has in store when it comes to the gold jewelry for men. He is definitely the pioneer in gold jewelry. I'm sure some of those brands will also be willing to take you brand ambassadors, Shail.
Sakshi, my better half refuses to walk next to me when I wear all my jewelry, and one of these days I'm going to launch a gold show. It will be called Gold Spot. But
Wow.
that, ladies and gentlemen, is more than enough that we can talk about gold. Here is the market in front of you, 72 points lower on the Nifty. This is a sensible start, 24,670. So the October 7th low has been taken out with a gap down. Now let's look at what the markets are telling us in terms of individual stocks. Look at IT. This is a 1 percentage point cut on the IT index, 42,315. What is Infosys doing? 48 rupees lower. I also want to see the move on Wipro. This is something, a 1:1 bonus will also do well. 1.2% higher, 535. Mayuresh, let's also discuss Zomato in a while. Second most active traded counter, 4% lower, a QIP on the way. They don't need the money, but they are trying to spoil the IPO party of Swiggy. We'll discuss that. Bajaj Auto, 1.7% lower, 99.49. What is the move on Polycab? Yes, this is the Havells impact, 5.5% lower, 67.39. How about Reliance? This is something that I want to check out. 11 rupees lower, 27.02. How about HDFC Bank? 11 rupees lower, 16.62. How about Havells? Flat, 18.03. And let's also look at Nestle at the same time, because it was also in pain as far as post earnings session was concerned. Nestle still down 1%, 2355. A very quick look into the broader markets. The losses on the Nifty are getting higher. You have a 100-point downtick now, 24,632. So the selling pressure is accelerating. Sakshi and I tracked 19 indices, all 19 of them in the red. Just 410 stocks are in the green compared with 1640 in the red. So it's not starting out well, ladies and gentlemen. Is the pain going to be over after this most recent low is being tested? Only time will tell. But please do not go long on the market. Let the week settle down. Mayuresh, a quick view on Zomato. They want to raise money ahead of Swiggy's IPO. I think this is tactical brilliance. What is your view?
Completely agree with you. So I think they are trying to actually preempt on what investors for Swiggy might probably be thinking about. And with the QIP, obviously, I think some element of funds move towards Zomato in a large extent and get away from Swiggy. So yeah, it's a good move that the management has probably thought about. What Swiggy is getting probably in terms of what we are hearing in terms of the pre-IPO trends was relatively strong as far as the CCPS shares were concerned. But I think this space generally is very, very hot, shares are at this juncture. You look at the raise that Zepto has done, one of their unlisted peers as well. They did, I think, a Series F funding, if I'm not mistaken, and valuations in excess of $5 billion dollars. So I think the space is hot. What they've done is a very, very good move, tactical move. But Zomato's own internal suggests that both Hyperpure as well as Blinkit should start, specifically Blinkit should start coming back in terms of the profitability zone, and Hyperpure should cut his losses. So yeah, I think valuations high, price action high, but anybody holding Zomato should continue.
Okay. Well, let's discuss the FMEG space. Yesterday, it was Havells' turn to slip lower on the back of its margins fall. Today, it's Polycab after the results have been lower than expectations, and it has missed the ground when it comes to even margins as well. In fact, the company has also highlighted that lower contribution from its high margin retail business in a highly competitive market has weighed on its bottom line as well. A 5.5% downtick on Polycab today at 6727. Let's get you to help us understand, Mayuresh. Should one use these dips to buy into Polycab? Will there be some more correction to go? Was it all froth in the top end right there with the kind of recent run-up that we had seen for some of these players?
No, I think the run-up was pretty stark. You're absolutely right. And I think there is no doubt that margins have come off for both reasonings that you put forth, Sakshi. So one, I think on the retail end, where they're saying there is competition pressure, they're trying to push through their volumes to maintain market share. And for pushing through volumes, you will take a realization hit as far as regaining or maintaining market share is concerned. At the same time, I think you've seen copper prices go higher in the preceding quarter, and therefore the entire contribution margins have come off. One more example might also be, if you probably seen the case of Havells as an example, the A&P spends have also gone up significantly higher. So I think you need to spend more, you need to push your products more at a lower price point with input cost inflation also coming in. You're probably expected to see earnings probably slow down. Now, they might be holding on to these high cost inventories, so part spillover might probably happen in Q3 as well for most of the companies within this spaces. But as prices start settling down, specifically on copper as an example, as A&P prices also start settling down, and the market demand starts coming back steadily, my own sense is that the earnings plateau or the downfall that we've probably seen might largely get contained as we end Q3. So yeah, I think it has been a tough quarter. The next quarter might be a little bit softer as well. But I think this is the time when the stocks might consolidate. And as they consolidate and as the data points evolve over the next few weeks and months, my own sense is that you will get better entry points at the moment.
921, ladies and gentlemen, it now gets worse. 24,600 is now safely with the bears. And this is not looking good. Is it the first 15-minute jerk that we are having, and then you will have a nice pullback? Only time will tell. But as it is turning out to be, it was actually a dead cat bounce. Now, what are the pain points? The pain points are Bajaj Finance, 58 rupees lower, 68.38. Hindustan Unilever, 27 rupees lower, 27.13. Infosys, 40 rupees lower. Nothing to be worried about on Infosys, at least. Remember, it had scaled up dramatically to a fresh record high. In fact, breathed above 2,000 rupees also for a very, very brief moment. And this is the selling pressure that is coming in after a decent performance in the second quarter. Reliance, disappointing, 23 rupees lower, 26.89. Let's look at how volume sales are happening at a time when you have a less than decent move on the market. Okay, Polycab is being thrashed, 5% lower at 67.63. Again, this is the froth that the market is now taking back. Already 65% of 5-day average has been traded as far as Polycab is concerned. Tanla Solutions, again disappointing numbers, 5.6% lower, 809, and again heavy volumes. Okay. Zomato is the top traded counter on the market today. Already 325 crores has been traded. People are exiting, or let's just say booking partial profit ahead of the QIP. 3% lower, 261. Zomato is also coming out with its earnings earlier than usual. And the star performer, ladies and gentlemen, will be Axis Bank post its earnings. Let's get Mayuresh's view. And just as I have said, that if you are fearless in buying pain, you've got it made, ladies and gentlemen. Let's look at Axis Bank chart. Mayuresh, a quick one from you on the earnings. Axis Bank at 200 DMA. Your view?
No, decent earnings. So you've seen asset quality pressure actually come off quarter after quarter. Obviously, the PAT had an impact in terms of a one-time gain that you've probably seen. But I think the advances growth were reasonable enough. Obviously, the entire deposit saga, as I've been time and again mentioning, might just play off. But how do the banks probably manage their treasury function is going to be extremely critical. Do they look at alternate sources of funding, whether it's CPs or CDs, to offset the kind of deposit pain that you're probably seeing in terms of accretive deposits coming through? What do they do with their time stroke demand deposits as well? Do they tweak some element of tenor rates as far as their long demand deposits are concerned as well? And do they tweak their advances rates as well? But it's very difficult in an interest rate cut scenario, Shail sir, and therefore I think how these trends evolve are going to be extremely critical. But I think very good numbers by Axis Bank. The commentary was also equally strong, and therefore I think banking, as I maintained, valuations in their favor. Expectations of some element of pain as far as deposits is concerned might continue, but there should be some element of normalization as we head into the second half and the next financial year. So I think BFSI, specifically BFS, is recently and well placed, if I may call it selectively, within private and public funds.
Okay, so Mayuresh, related sectors, AMC, broker space, they have been in some action despite the overall downturn in the market. How are you looking at some of these players which have come up in trade in the last few trading sessions?
So we all talk about financialization of savings, and that is playing out for AMC stocks. You've seen SIPs continue unabated. Expectation is that they will still continue growing strongly. The equity mix within the equity debt mix for AMCs remain extremely strong, expected to grow at a decent pace because of both the SIPs, the lump sums, and more schemes that are probably getting launched, looking at the and at a market placement as well. You had some jitters a few quarters back when the expense ratio was probably getting determined and capped. But to a certain extent, I think the leverage portion plays out. I think if this flow continues, even with the capping of the TER, a large part of the costs have got built in over the last few years. I think a lot of cost absorption has probably happened. Incremental variable costs are going to be not in proportion of the growth that you're probably expected to see in terms of inflows, and adjusted for the kind of margins or EBIT performance that these stocks make. So well placed. I think a large move has already happened. But yeah, AMC as a space looks interesting. Anybody holding on to stocks like an HDFC AMC, UT AMC should continue holding. Again, a quick disclaimer, HDFC AMC is something that we continue holding in our global portfolio.
Right. Mayuresh, thank you so much for your time. And as always, it's a wonderful conversation. You have to come to Delhi, and I'll show you my gold collection, which is not going to be photographed.
Thank you so much, Shail sir. Thanks, Sakshi. It's always a pleasure on a Friday.
With that, ladies and gentlemen, we bid Mayuresh goodbye and welcome an equally cerebral equity strategist, Ms. Shibani Sharkar, Senior Executive VP and Fund Manager, plus Head of Equity Research at Kotak Mahindra AMC, joins us to discuss the festive season and the festive sale that is right there in the markets. I am sure, Shibani, you are rubbing your hands with glee looking at this correction which is now upon us. How do you analyze sentiment on Dalal Street? And then we will discuss gold and the Indian housewife.
Sure. Hi, and always a pleasure to be on your show. So, when you look at Indian markets over the last 3 years, markets have done exceptionally well, even on a relative basis as well as absolute terms. And therefore, when markets have done so well, it is but natural to see some degree of volatility. And this volatility has been brought about by both external and some internal factors where markets are concerned. On the external front, of course, there is this whole debate about China. There are geopolitical tensions, and of course, the outcome of the US presidential election and growth globally. So, there are many factors at play. Where our markets are concerned, Indian macro continues to hold up, especially in a relative context in terms of growth, inflation, as well as interest rate trajectory. However, one factor that we need to keep a watch out for is what's happening on the corporate earnings front. And our belief has been that corporate earnings has been one of the key drivers of markets so far. Now, when you look at corporate earnings specifically over the last quarter or so, you've seen some amount of moderation in the trajectory of earnings, while the earnings itself have been largely in line with estimates, but estimates have been muted. Even in this quarter, as we are entering into the Q2 earnings season, the estimates for the quarter are fairly muted, and therefore the onus is on the second half of the year for earnings to pick up and get closer to the double-digit earnings growth expectation for FY25 and then mid-teens for FY26. And therefore, for our markets, corporate earnings and the delivery, specifically in the second half of the year, becomes extremely important. Now, we've always talked about valuations. Valuations continue to be elevated for our markets, and that's also a factor to watch out for. However, if the earnings trajectory does play out as is anticipated, some of that valuation, especially where large caps are concerned, are possibly justified to a great extent. However, one can't look away from mid and small cap valuations where multiples on a relative basis, as well as with respect to history, are at a premium of about 30 to 40%. And therefore, one has to be selective where mid and small caps are concerned. So, in that market construct, while the medium term trajectory remains fairly intact, near term volatility is something that we will have to navigate at this point in time.
Very good morning to you, Shivani, and thank you so much for taking the time out. It's always a pleasure to listen to you. With such clarity, you give all your thoughts that it really helps all our viewers to really fathom the right way to assess the markets in this current very, very volatile and downturn as well. Help me understand, do you see a bottom near in the current fall in the markets? Or, and where do you think recovery to begin? In which sector do you think the recovery will first start?
So absolutely. So our belief is that as long as the earnings trajectory remains by and large in line with consensus, we've started seeing some degree of earnings downgrades, but it has not been meaningful, maybe a few percentage points here and there. But if earnings delivery plays out, then the market would see some degree of volatility, but may not see a sharp downturn. Also, remember in this sort of a market environment, from the macro perspective, India continues to shine in the global context. And secondly, while there is volatility on FII flows, the domestic flows continue to remain fairly strong and solid, providing support to the market. And therefore, while we can see volatility or consolidation, it is unlikely to see a sharp downturn, unlike what we saw in past instances over the last couple of decades when there were global events which led to the sharp downturn in markets. So that's number one. Second question that you asked is from a sectoral perspective, where do we still see valuation comfort? There are a couple of sectors that I wanted to discuss. First and foremost, our belief is that the entire consumption pact seems to be well placed, especially with context of where incremental growth is coming from, some amount of revival on the rural front and the demand trajectory, which should start to improve post the festive season, as well as with the monsoons, as well as the Rabi output likely to be good. So that's one pack that we are watching out for and where we believe that risk reward still is in your favor. The second segment is technology, especially where the large cap tech players are concerned. Here we have seen some up move in stocks, but here still valuations remain fairly reasonable, especially where some of the large cap tech players are concerned. And we are starting to see, if you look at commentary from some of the companies that have reported numbers already, there is improvement in terms of discretionary demand, specifically in verticals such as BFSI, where ultimately some of the larger players would possibly stand to benefit considerably. Some of the discretionary spends coming back, as well as the structural opportunity where Gen AI is concerned, makes us fairly positive where the tech sector is concerned. However, one caveat, of course, some of the stocks have seen some recent
Yes.
up move, and therefore one would have to be somewhat patient where the sector is concerned. And the third aspect is banking, especially again the large cap banks. There is a considerable degree of struggle or challenges in the sector where loan growth has been coming off, margins have been under pressure, some amount of credit cost inch up where unsecured lending is concerned. However, valuations seem to reflect a lot of those concerns. And therefore, if you have a slightly longer term view, the risk reward will possibly be favorable where some of the larger banks are concerned. So these are the three sectors where we believe that valuation still provides some degree of comfort in this current market environment.
Okay. You preempted my next question, Shibani, and this was on IT. Nothing has changed in terms of the guidance that is coming in from the big boys, and nothing has also changed in terms of this relentless pursuit of mid-cap IT companies by people of all hues, whether it is ultra HNIs, whether it's fund managers or normal retail traders. Yet there is this change in sentiment or perhaps appreciation that IT hasn't outperformed the momentum boys in other sectors. Within this space, where would you put in your money? On large caps, look at Wipro. It's given a negative guidance today, and the counter is up 5.5%. Perhaps a 1:1 bonus. Again, it's the retail brain that is running the show entirely on markets. How do you see this conundrum?
Yes, so absolutely. So if you look at, just take a step back in terms of what happened with the technology space post-COVID and why the sector saw a sharp downturn and underperformance, was the fact that a lot of spends that were discretionary in nature were made post-COVID, and those spends were clearly excessive. And then you saw the global downturn in terms of growth slowing down, and therefore discretionary spends on IT were cut back significantly. Now you're coming to a stage, especially in the global context, where central banks around the world, including the Fed, have started to cut rates. The US economy seems to be heading for a soft landing, and therefore there is some degree of macro stability that is coming back, especially where large geographies such as North America are concerned, which contribute significantly to IT services revenues where Indian companies go. So that's number one. Second is, if you look at commentary that's coming through from large verticals like BFS, and some of the numbers that have already come through, there does seem to be some amount of improvement in discretionary spend that is anticipated. You're right, nothing has actually come through as of now, but incrementally commentary seems to be getting better, especially where BFS, high tech, cloud migration, etc. is concerned. There is a lot of structural positivity in the sector as well, where the entire AI story goes, where incrementally Indian IT services players would have a large role to play as and when Gen AI adoption increases across for the overall space. So our belief is that possibly the worst is over in terms of the demand trajectory where IT services go, and you should start seeing an improvement going forward. However, remember that when you look at the second half of the year, especially Q3, seasonally Q3 is a weak quarter. You do see furloughs, you have lesser number of working days, and therefore there will be some degree of seasonality that plays through, especially where Q3 and to some extent Q4 goes. But as we go into Q4 and January of next year, a better sense of how IT budgets are panning out for some of the large clients will also play through. And therefore, from that perspective, large cap IT players continue to be well placed. Of course, mid cap has outperformed the large cap space because typically growth tends to be higher where mid caps are concerned. However, we would be selective at these valuations where mid caps go, and risk reward seems to be a little bit more favorable where large cap IT is concerned. And also, as we were discussing, some amount of that revival that you're seeing, especially where BFS or high tech goes, some of the larger players would also tend to benefit in that kind of an environment. And while being selective and stock specific where mid caps go.
Shibani, the other key sector that we want to discuss with you is the auto space as well. Now, a month back or so, this was the poster boy in the markets, and suddenly all of these stocks are applying strong breaks that's hit speed breakers as well. There's a sentiment loss. Even in the earnings space, there has been some kind of a miss as well. And this all happens at a time when the country's second largest car maker has launched its IPO after almost 3 decades of existence. Your own sense of how are you assessing the auto space at large, both the four-wheelers and the two-wheeler space? We've seen what happened with Bajaj Auto yesterday. Hyundai IPO just sailed through on the back of only QIP sales picking up. Your own sense of how are you assessing the space from here on?
So absolutely. So auto has been a segment where we have also been fairly positive on, across for the last year or so. Our belief has been that incrementally demand has seen a revival. However, if you look at the overall positioning, clearly at this point in time, our preference is for the two-wheeler segment over the passenger vehicle space. And this ties in with our thought process that there is some improvement that is taking place where rural or mass consumption is concerned. If you look at various data points that are coming through, one, of course, the monsoons have been good. Secondly, the impact of the MSP hikes where the Rabi crop goes, as well as expectations of a good impact, good output on Rabi. And also the data points which are coming through from the rural side in terms of employment, etc., seems to suggest that there is some degree of improvement, especially where mass consumption or rural consumption goes. And that kind of ties in with commentary that you're seeing from various consumer companies as well. And this we feel bodes well for the two-wheeler segment, not so much the premium, but more specifically the mass two-wheeler segment. So that's one area that we continue to remain positive on. Now, the overall space, of course, in the last 1 year has done reasonably well and has outperformed, and we are cognizant of valuations to that extent. And therefore, from that perspective, where segments or stocks where valuations have run up ahead now of fundamentals, one would need to be cognizant of the same. However, as I said, that within the two-wheeler space, those companies which are largely present where the mass segments are concerned appear to be well placed. Here again, valuations in pocket continue to remain reasonable. And therefore, within the auto pack, this is our preferred segment where we continue to believe that there is scope for growth to come through. The second aspect where autos are concerned is on the margin front. We believe that with commodity costs remaining largely under control, margins should hold up, and as growth picks up, some amount of that operating leverage should also play through, and therefore that should support margins. But yes, again, within the pack, I must put in a caveat that our preference at this point in time is for two-wheelers over the passenger vehicle segment. We'll also have to wait and see how the festive demand really plays out. Within the passenger vehicle segment, of course, there are reports which have come through of inventory buildup in the system or some amount of the discounting that is taking place. And therefore, the completion of the festive season and the demand flow through is also something that will be of importance where the entire pack goes.
Correct. And Shibani, listening to you, the Nifty is bounced 100 points from its most recent low. Let's hope this festive cheer is also resulting into some quality festive buying on the index and index components as well. I wanted to understand the overall status as far as Kotak AMC is concerned. Have you raised cash levels over the last 3 months relative to inflows that are coming in the sense that you have a monthly SIP as a AMC that is coming in, and that's cash, immediate cash, and of course the profit booking that you may or may not have done in mids and smalls. Net of this, what is the situation of cash in Kotak AMC?
So at Kotak AMC, our philosophy has always been that we don't look at cash as an asset allocation tool, specifically for our equity funds. So for us, cash levels have typically been in the range of about 2 to 5%, and that has been mainly for liquidity purposes only. So while the thought is that when you're running an equity portfolio, the cash is not used as an asset allocation tool, and we typically run fully invested equity portfolios for our only equity funds. And that same thought process continues. So given the way the markets have been, our positioning has moved somewhat more towards being slightly overweight on large caps, slightly underweight on mid and small caps, and being very stock specific. Look at companies where valuations are reasonable, look at quality, companies which are still trading at reasonable valuations and look at companies where the overall liquidity is fairly intact. So that's how we have positioned our portfolios. But cash levels have remained fairly in that range of about 2 to 5%. So there has been no major change in terms of thought process. And as I mentioned, as a philosophy, we do not use cash as an asset allocation tool. And therefore, cash levels have been largely the same. There has been no increase in the same.
Okay. Shivani is,
Shivani,
yeah,
it
sorry.
must be gladdening your heart seeing the value discovery that is happening in the AMC space. I'm sure you must be ruing the fact that Kotak has a single listed stock, which is the bank, and a lot of value creation has happened in rival AMCs. Ballpark, how do you see this sector? The frenzy that is in the buying of BSE at a time when it just sort of worries me no end that people are not looking at the structural construct of the sector, which is contracting in terms of volumes, and here they are ramping up BSE because they think that it'll get more market share. It sort of defies practical logic. How do you see it?
If you look at the entire capital market space, including asset management companies, and without going into a specific name, we believe that the entire AMC pack or even some of the wealth management pack is fairly well placed. Of course, there has been fair degree of outperformance, and one has to keep valuations in mind while looking at this segment. But look at it from a structural perspective over the medium term. The entire thought process that if you look at the entire AMC space, one, the SIP book, which provides fair amount of sticky inflows that come in. Secondly, the entire overall financialization of savings, which is bringing into play the entire asset management space. The third aspect is that from a competitive intensity as well as composition, equity as a proportion of AUM has been going up, and that provides some degree of stability where yields are concerned. And fourthly, this is a fairly high ROE generating segment, given the kind of growth as well as capital requirements that you have for this entire space. So in that context, where you are starting to see top line growth, market share shifts, and consolidation as well taking place in the sector, where the top five, top six asset management companies are fairly gaining share. The second aspect, of course, is it's a high ROE generating space and earnings growth flowing through primarily because of the shift in terms of the AUM profile and within asset classes. So from that perspective, the asset management space does look fairly well placed. Of course, within the space, one would have to look through companies where valuations have run up with respect to growth and ROE. And keeping that in mind, from a structural perspective, if you look at a medium term perspective, this space continues to be fairly well placed within the entire capital market segment.
Shivani, I wanted to also understand from you, how are you really looking at the PSU space as of now? The erstwhile outperformer has been in a long drawn time consolidation now. Have you pulled out most of your profits right there and shifted it elsewhere, maybe even to private banks per se? How are you really looking at the PSUs and what's your approach there now?
So, when we've looked at PSUs, even in the last rally, when PSUs overall as a pack did extremely well, we've clearly looked at PSUs the same way we look at all companies. Evaluate companies on the basis of their fundamentals and valuations, and not purely on valuations. And that's the thought process that we continue to apply where PSUs are concerned. I think one, the way market typically tends to look at this pack is to look at it as a whole or as an entirety. However, remember there are PSUs that operate in different segments with different return ratio profile, different earnings profiles, and different valuation metrics. And hence, for PSUs, you need to evaluate them in the segment in which they operate in. And from that context, if you look at the PSU pack today across segments, we still believe that there are pockets of opportunity. For instance, among the larger public sector banks, valuations appear to be fairly well placed at this point in time. We would also be, looking at segments such as power utilities, where the entire thesis of demand being ahead of supply continues, and therefore there are pockets of opportunity where PSUs are concerned. However, as I said, that one needs to look at each of these names in their own context evaluate them with respect to valuations, with respect to liquidity in the stock. We've also seen that in pockets where the stocks have limited free float, where valuations have run up considerably ahead of their estimates, one needs to be careful and avoid that pack. And that's something that we've been doing consistently over a period of time. So yes, there are some pockets of opportunity, but as I said, one should be careful about being in stocks where valuations and the overall fundamentals tie in.
Okay. Shibani, you've very brilliantly and intelligently laid out your investment thesis for the market ahead. Now tell us, is there a space that you missed in the last 18 months on the long side, and maybe that space has corrected sharply over the last 3, 4, 5 months or so, and now you look forward to perhaps having a second innings in that sector? Do such how should I say, dream stories exist in a market like today?
Well, I would not put it so much as from a sector perspective. However, when you look at the entire broader market, there have been companies that have corrected considerably from their 52-week highs that they have been trading at. And like I was pointing out to you, that when we look at the entire mid and small cap space, at a headline level, valuations still do look elevated, specifically with respect to their own history. And valuations are, of course, at a premium to large caps. But within the mid and small cap space, we always keep an eye out on stock specific opportunities where we believe that if valuations do come off and if valuations tie in with fundamentals, there are opportunities. So I think, when we look at markets today, while at the headline level, the correction may not seem as steep as what it appears at a stock specific level, there could be some opportunities that do come by, but these would be largely stock specific in nature. Now, from an overall market construct and valuations, as we were earlier discussing, from a sectoral perspective, the only sectors where we still believe that valuations and risk reward are largely in favor are the three sectors that we discussed. There are pockets of opportunity in the consumption space, technology, and to some extent in the banking, large banking space as well. Now, from a portfolio construct, if you look at our portfolios over the last few years, capital goods, industrials, infrastructure, this has been one space where we have been extremely positive on. Structurally, the positivity continues, and we believe that this is something that will possibly play out over a period of time. However, we are also mindful of valuations in this space, and hence, to that extent, where valuations have become extremely uncomfortable, we have taken some profits off the table where that sector is concerned. But to answer your question, from an overall sectoral perspective, the three sectors where we still see risk reward are the three that we discussed, and the rest would be largely stock specific, where some of the mid and small cap names are concerned.
Right, Shivani, it's been a wonderfully educative exercise in trying to understand how you see the market at this level. And of course, we hope to, both Sakshi and I hope to either meet you in Mumbai or host you in Delhi in our studios soonest possible. Thank you so much for your time. And we missed that question on gold, but there's always a next time. Thank you.
Thank you so much. It's always a pleasure interacting with the both of you, and I look forward to my next interaction. Thank you.
Thank you so much.
With that, ladies and gentlemen, we'll wrap the market. I think the worst is behind us. 24,575 is the low that we have tested. At the moment, the Nifty is at 24,686. Let's hope that the selling pressure is over, and today we will have a long tail. I'll explain this long tail in the 2:30 show, but for now, let's wrap it.
Right, so there you have it, about 24,680 odd levels on the Nifty, 72 points lower in trade. Private banks are actually taking the front row today, 0.8% higher. That's also driven the Nifty Bank into the green. That's the only major index that's holding up into the green, 0.3% higher. Autos are also coming back from yesterday's carnage, and financial services are supporting the sentiments as well. But rest, all of the sectors are still lower in trade. Oil and gas is the one that has lost the most, 1.2% lower. FMCG, IT, small caps, consumer durables, these are the other key sectors that are still dragging and weighing on the sentiments. Wipro is the top mover on the Nifty right now, almost 5% up in trade. Axis Bank post earnings too is up by 4%. Eicher Motors, Tata Motors returning from the drag yesterday. ICICI Bank and HDFC Life also supporting the sentiments on the street. While on the downside on the Nifty, you have stocks like Infi, that's now dragged 3% post earnings. BPCL, Titan, ITC, Nestle, Bajaj Auto, these are the stocks that are still lower by over 1% each in trade today. We'll be back with a whole host of market coverage through the course of the day and earnings conversations too. So stay tuned for that, viewers.
Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching a very special episode of Easynomics Today. We do a deep dive into India's economic future basis exclusive insights from a recent UBS report. Joining us is Tanvi Gupta Jain, the Chief India Economist at UBS Securities India. And the focus of that report, as I welcome Tanvi, is about India setting its sights on becoming the world's third largest economy. And that leads to a lot of crucial questions, including what happens to inflation, job creation, our fiscal policies, interest rates, and all of that. Tanvi,